The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Good morning or good afternoon, based on where you're located in the region. And thanks so much for joining today's webcast hosted by Avalara featuring Bloomberg. My name is Ali Ortiz, and I am the ISV Program Manager here at Sage. Just a few logistical items before we get started. The presentation will be around 50 minutes, so we will have some time for Q&A at the end. So please enter your questions in the Q&A panel on your screen, and we will make sure to go through those. The webcast will also be recorded, so we can distribute the recording and a PDF of the slides next week. With that said, I will go ahead and pass it over to Rosalinda Martinez from Avalara to kick off the presentation.
Good morning, everyone, or afternoon. Thanks for joining our presentation. Today, we're going to cover how to drive efficiency with compliance automation in today's economy of constant change. And oh boy, there has been a lot of recent changes just within the last 4 weeks. So we feel that there's going to be a lot of relevant content to all of those of you that have joined us, and some key functionality and features that Avalara offers to help your business drive that efficiency. We're joined today by a panel of presenters. We have our expert from Bloomberg Tax, who is a senior correspondent there, Michael Bolonga. Sorry, I messed that up. I asked him how to pronounce his name. He writes a weekly column about tax and local taxes, along with cryptocurrency and other relevant taxing digital product information. So thank you for joining us, Michael. We also have Scott Peterson, who is our Vice President of U.S. Tax Policy and Government Relations at Avalara. He is a well-known, recognized expert on sales tax. He's been featured in Accounting Today numerous times, and the most influential people in accounting. And we are excited to have both him and Michael give us all those relevant, just ever-changing tax legislation happenings that are going on. We also have Alex Lyons and Brad Hamlin, who are sales executives with Avalara. They will cover some of the new products, features that Avalara offers to really help you drive efficiency with your tax automation and compliance. So with that being said, we'll go over a quick agenda. We're going to first cover the impact on the economic landscape and on tax policy. We'll then move into some updates to corporate income tax rates. We'll dive into the latest in economic nexus, some state-specific updates, and then those relevant tips to streamline and drive efficiencies, and follow up with what we hope will be a great Q&A session at the end. So I will turn it over to Scott to begin the presentation.
Thank you, Rosalinda. Appreciate it, and thank you to our friends from Sage. We do greatly appreciate our relationship with you. Hopefully, we're both benefiting equally in this relationship. So today, we're talking about tax policy. We're talking about tax changes. We're talking about how things outside of our control impact the way we have to deal with our friends in government. And one of the things that we're all benefiting from, the business community, Avalara, I assume Bloomberg, and the states, is this crazy change that's going on in technology. Everybody is moving to a new platform, and everybody is going somewhere where they had never been or never thought they would be with technology. I mean, one of my jobs is to talk to states about technology. I mean, I want them to be out ahead of the curve when it comes to what is physically possible, and it's a hard conversation to have with them because they're a little bit on the conservative side in that they don't control their budget. And given they can't control their budget, they can't make promises on where they'd like to be. And sometimes they don't even know where they want to be. and which is my job. My job is to tell them where they want to be. We're seeing a continuation of the modernization and of electronic filing and registrations. We're seeing a movement towards single sources of truth for data collection and validation. And it's helping artificial intelligence, machine learning is getting states to a position where they can share information in a way that makes it easy for us and all the taxpayers in the world to find it. And automating exchange of information. That's really critical these days. It's very frustrating in this three-part process that we all live in, the government, business, and Avalara, that we know someone has the information. We have it, the taxpayer has it, or the government has it. And being able to get that and all three parties need it. Getting that information back and forth between the three parties efficiently and in an automated way is critical for this world we live in, which is real-time transactions. So, and as an example of that, the Rhode Island introduced legislation that would require credit card companies to report tax amounts to state and local jurisdictions within 48 hours. This isn't a new idea. It's an idea that comes from the belief that why shouldn't the government know at the time the transaction occurs? And there's lots of financial reasons why it's hard to do this. But the reality is there's two people probably three people that already know that transaction occurred, and the government wants to know why they can't be the fourth. Next slide, please. We've seen this, and Michael's going to talk a little bit about this as well. Last year, arguably, states are still very flush. They have lots of money, and there are only a couple that are actually would say that they don't have a lot of money. But what we saw this year in state legislatures was a stepping back from spending that money, either in new programs or additions to existing programs or in tax reductions. As state economists looked at their economy, and every state's economy is different. Just because one state has a lot of money doesn't mean the neighboring state's going to have a lot of money. As those state economists looked at their own economy and spending, many of them have advised their governor and the legislature to maybe hold back until next year when it comes to spending that money. Just because you have a budget today, a surplus today, doesn't mean you'll have a surplus tomorrow. In California, a good example of that. Last year they had like a $50 billion budget surplus. This year got a $30 billion budget deficit. So state economies swing rather significantly, and tax collections go along with that economy. So we've seen this fear that something's going to happen impact the way states spend money. Lots of legislators and governor went into this year thinking, well, I'm going to get rid of this tax. I'm going to get rid of that tax. I'm going to grant an exemption to these people. And an awful lot of that didn't happen because they were concerned about the economy. And the example is a great example is New Mexico, although there's been several others. Kansas is another good example where the legislature and the governor thought they had a plan at the beginning of the year, and as the session went on, as the months went by, the governor got nervous. In both those cases, vetoed legislation that was in many ways kind of their idea in the first place. Next slide, please. Let's have a poll.
Right. We are going to launch our first poll question. So I'm going to go ahead and launch it. Everyone can take about 30 seconds to answer it. Where do you feel your organization falls currently from a sales tax compliance standpoint? I'm in trouble, sweating a bit, we may have some room for improvement, or we would ace an audit. So if everyone could just take a few more seconds to get your answers in, that would be super helpful. All right, I'm going to go ahead and close the poll out in 3, 2, 1. All right, Scott, back to you.
Thank you. So let's transition over to Michael here to talk about something outside of what Avalara normally does. We're a transaction tax company, but the world is a multi-tax, and it helps, I think, the audience understand how budget decisions are made and tax policy decisions are made when you include the entire picture of the type of taxes that states has. Michael?
Sure. Yeah, can we have the next slide? Yeah, perfect. So as Scott was saying, you know, I think states are flush with money still, and that turned into a lot of rate reductions last year. And so you're seeing in this slide that Arkansas, Iowa, New Hampshire, Pennsylvania, Idaho, and this is just an example, all had significant either flattening of their corporate income tax rates or reductions, or some modification that sent money back to corporate taxpayers. And so in many cases, we started the year that way. And I would say, looking at the legislative sessions, there was still some appetite for further rate cuts. And, you know, I've been paying attention to a couple states in particular just in the last couple months. Nebraska did some further flattening of its corporate income tax rate. It's long term, and the hope is that they can bring that down to 3.99%. Louisiana is just in the final days of its legislative session. Not a huge amount of cutting going on there, but they did pass a bill, and it's expected it'll be signed shortly, where we would have a phase out of the corporate franchise tax over 4 to 6 years. They're going to pay for that, though, with some reductions in the tax credit programs available for new and expanding businesses in that state, but still an indicator of corporate rate reductions. New Jersey has a few more weeks left in its legislative session, and they're looking at a rather expansive corporate income tax overhaul program, but also some rate reduction. There's a 2.5% surcharge currently in New Jersey, which puts lifts its corporate rate from 9% to 11.5%. But the legislature and the governor are prepared for that to expire by the end of this year, and it looks like that's going to happen. So New Jersey is another example where we still see some rate reduction happening, and Connecticut, well, Connecticut is out there too, but it looks like they're actually raising rates a little bit. So they also have a business tax surcharge of 10%, and the latest thing we're hearing is that the legislature is going to extend that for another 3 years. So a mixture of things going on, but I would still say on balance, mostly rate reductions. We're going to talk about Minnesota in a few minutes. That's kind of an unusual case that I think is worth taking a deeper look into. But going forward, based on what Scott said about uncertain revenue going forward, if the country goes into a recession, then it'll go into recession at some point. I think we will see some pressure on corporate income tax rates, particularly in the blue states, and things to keep track of, and you'll see this on the right side of the slide, is, well, in terms of personal income tax, maybe some pressure on the wealthiest in a state. So wealth taxes or special taxes on capital gains, perhaps some crackdowns on aggressive tax avoidance through family trusts. We saw a discussion of that in California this past year, although I don't think it went very far. And then possibly some special taxes on profitable corporations. We're going to talk a little bit later about Maryland and its digital advertising tax. That sort of falls into that category too. But anyway, the story in terms of corporate income tax rates could be quite a bit different if the economy begins to cycle downward. So anyway, I don't know. I think Scott, are you next? Yeah.
I am next. Yep. Thank you. Appreciate it. So the latest on economic nexus is Missouri. Missouri's legislation went into effect on January 1 of this year. They did what every other state's done. They imposed a tax collection obligation on retailers who aren't in Missouri, who sell into Missouri, and they imposed the same obligation on the marketplaces. We are now 11 days away from the 5th anniversary of the United States Supreme Court decision that made all this possible. So, Brad, can you give us an idea of what you're hearing on the street? What's new out there?
Yeah, sure, absolutely. And thank you, Scott. It's tough for me to give the advice and the overview of your home state, right? But I'll do my very best. So, we appreciate the opportunity here to speak to our Sage customers, and the experience that Alex and I can bring is really the day-to-day conversations that we have. So we have this conversation. I've had it twice today already. Really, what our customers and potential customers are concerned with as it pertains to what economic nexus means for them. I don't want to take it back too far, but I always find it helpful to just define what nexus is. So because there's lots of different types. So from a sales tax perspective, it's simply your obligation to collect and remit sales tax in a particular state or jurisdiction. The historical norm was physical nexus, which most of our customers are familiar with. Everybody had a pretty good grasp on, right? People, property, inventory, or particular state created that obligation to collect and remit. I think one of the challenges in this digital age that we live in now, this post-pandemic world, is through the pandemic, folks were hired everywhere. So if you hired employees in additional states that you're selling into, that has the opportunity to create physical nexus if you've not yet reached the economic nexus thresholds, right? The economic nexus institution came about in 2018. Company Wayfair was sued by the state of South Dakota, went up to South Dakota, felt like there's a lot of furniture being sold in their state and they deserve some of the tax revenue from that. So that went up to the Supreme Court. They ruled in favor of South Dakota, which unilaterally gave them the opportunity to create an arbitrary threshold for economic activity across state lines where it would put the onus on the retailer to then collect and remit sales tax in that state. So as you can imagine, all the states followed suit from there, all created their unique thresholds. Some of them followed suit with what South Dakota decided. Many of them had different and subtle differences in their thresholds. In terms of changes and what's happening now, they're pretty much at the levels where they are. So Scott had just mentioned that Missouri just instituted their economic threshold at the beginning of the year. They're the last of the 45 states that have a sales tax regime. And they also just started to tax software as a service. So any of my customers that were selling software into Missouri had to start applying sales tax to it as of January 1st, 2023. Right now, really the portion that we're in is the enforcement phase, right? So the auditors at the state level are coming in and asking difficult questions. When did you start selling in our state? And what are you selling in our state? Based on the answers to those questions, they can go all the way back to 2018 to look for receipts of what was sold and ensure that it was being done appropriately, right? The other change that anecdotally I've heard from my customers that have been in business for a long time is the auditors no longer are knocking on doors. They don't need to. So their audit process is to send an email and request this information, and it's very quick and they don't even have to be there. So that's one of the other realities of the current state of business that we're in, right? Next slide. I think we have a poll question here.
Yes, we do. So I'll go ahead and launch this poll. How confident are you that you're registered and collecting in the correct jurisdiction or states? Very confident, not confident at all, or I'm not sure, I'd like help. So if you could please take a few seconds to answer this poll. All right, and I'm going to go ahead and close it out in 3, 2, 1. Back to you, Brad.
Okay, thank you so much. So this slide, again, just gives kind of a high level of what those thresholds are by state. So California, Texas, and New York all have a sales tax threshold of 500,000 in gross revenues. Most of the states are that 100,000 with 200 transaction tier or threshold. Some of the states are repealing that 200 200 transactions threshold, so that's something to look out for as well. I think just broadly, and I'll paint with a very broad brush for a second here, there are certainly varying degrees of this, but there's generally two types of conversations that I'll have with customers that are looking at Avalara. There is the first that is just starting out on their journey. They're just starting to create Nexus in a few states, and they want to stay ahead of this curve and ensure that they have this infrastructure in place. That's the right way to think about this. If you get the compliance structure in place, then businesses are free to grow their revenue opportunities, the products that they sell, and not really have to worry about what the tax implications of those decisions are from a sales tax perspective, right? The other end of the spectrum, I see this a lot with software companies in California. New controller, a new CFO comes in to help out the organization, takes a look at the books, asks what they've done in as it pertains to sales tax, and they get the deer in the headlights look. So very often, software companies originate in California or New York. In California, software will never be taxed, right? So if they generate it there, they start selling there, they license it in other states, they typically don't understand that they're creating a tax obligation in another state. So Avalara luckily has the ability for our customers to come in and really understand where those obligations may lie, what the exposure might look like, and offer our assistance in that. And my colleague Alex will talk about that a little later in the presentation. Next slide. So not to be outdone with the different thresholds by state, there's also different definitions about how the states calculate sales. So as you can see, this map really differentiates the different states for what type of sale they're looking for. Some states are gross revenue, I would say, and Scott could probably provide some color on this, but most of the states are moving to a gross revenue method of looking at sales tax. They want to know exempt sales, non-taxable sales, the entire revenue picture. They want the entire picture to determine what the taxable sales are. They want to maximize the amount of taxes that they're collecting. Well, from what I've heard from both Mike and Scott is that taxes isn't going to get easier as we move forward, as these states run deficits and have these fiscal challenges. I think the overarching complications for our customers is that they're going to get more aggressive in how they collect tax, what they collect tax on, and ultimately what the thresholds are. So that's just a little color on economic nexus and other types of nexus and how we can help here. Next slide. And I think this goes back to Scott.
Nope, we're going to go to Michael now.
Okay.
All right. Yeah. What does the slide show us here? Oh, okay. So I'm just going to discuss a couple sort of mini themes that I was watching this year, and one has to do with the SALT cap. Maybe a lot of you remember that under the Trump tax reform bill in 2017, they created this $10,000 cap on state and local deduction limits. And as a result of that, states were looking at a way to sort of work around that that process. And so the thing they landed on is what we call the SALT cap workaround. So what we're seeing now is that these workaround laws are basically the norm. There was a huge number of these laws that were enacted just in this past year, and the American Institute of CPAs tell us now that about 35 states and New York City have all approved laws, and what they essentially do is permit pass-through businesses, including partnerships and S corporations, to pay their taxes at the entity level. And then that entity level option permits state tax on the income of the equity owners to be fully deductible from their federal tax returns and not subject to that $10,000 SALT cap. So just in the last month, actually, Iowa, Hawaii, Nebraska, Montana all passed these kinds of bills. So I said before there were 35 states that have these kind of bills now, and then when you add 9 states where it's not possible to have one of these constructs, the only sort of outliers left are Delaware, Maine, North Dakota, Pennsylvania, and Vermont, and the District of Columbia. And I think even within that group, there might be some action, maybe in Pennsylvania, before the end of the year. So Anyway, that's one way to just. It was a major development this year, and we'll see where this goes in future years. The SALT cap is supposed to expire, I think, in 2025, and then we'll have to see what if anything the Congress does on this issue, and I suspect the states will have some sort of response depending on where this goes federally. How about the next slide? Maryland, okay. Maryland is such an unusual case. It's the only state in the country that has a digital advertising gross receipts tax. And this is a tax of between, I guess, 2.5% and 10% on the gross revenues from digital advertising attributable in Maryland. But it's only levied on companies with annual revenue above $100 million. And so I think the original intent was that this was going to fall on basically on social media companies, search engine companies, digital publishing companies. And I think it was Maryland's way of, and it resembles in many ways things that are going on in France and India and other countries in the EU. There was a feeling that they weren't getting any tax revenue from the likes of Google and Facebook and other large tech companies, and so this was their effort to extract some revenue from them. Now, the tax, which kind of went into effect at the beginning of 22, was immediately challenged by the U.S. Chamber of Commerce and by in federal court, and then separately by the companies Comcast and Verizon in state court. There was this was a very high-profile bit of litigation, and there was a lot of anticipation that the tax would be struck down. And it was struck down at the trial court level, but then we had a decision just on May the 9th in front of the Maryland Supreme Court, and the court essentially punted. They vacated that earlier ruling at the circuit court level that struck the tax down, and basically what the Supreme Court said was Comcast and Verizon should have exhausted their options at the administrative level, so that would have put the whole question through the Maryland tax court, and so they were basically sent back to this administrative level where they were going to have to apply for a refund and then litigate the case at an administrative level. This essentially puts this whole Maryland tax question on a path that could take 2 or 3 years to make it back to the Maryland Supreme Court, so that we would have a decision on the constitutionality or the legality of the tax broadly. Now, this is kind of an important thing to mention, because if Maryland is successful, and it's not clear that they will be, but if Maryland is successful, you can bet that, I don't know, 5 or 10 or a dozen states will enact a very similar law, because there's a feeling among the states that, like I said, this is revenue being created on the backs of their state, their consumers in their states, and they're not getting their pound of flesh from it. But it will certainly be litigated going forward. I was just at a tax conference at Villanova University, where the senior counsel for Comcast and Verizon said that he believes, and others believe, that the tax is unconstitutional and a violation of the Federal Internet Tax Freedom Act, and that they were going to continue to litigate this. So anyway, that's the Maryland story. Stay tuned. And Minnesota, I thought I would just mention Minnesota also, just because they just finished their legislative session. And Minnesota, interestingly enough, was a state that had something like $17 billion surplus. But because they had a legislative trifecta with Democrats for the first time in maybe a decade or longer, so you had Democrats controlling both houses of the state legislature and the governor's mansion, and they saw this as an opportunity to do some rather dramatic things. So despite the fact that they had a surplus, a substantial surplus, lawmakers did something quite interesting where they imposed both the biggest tax cut in state history and also the biggest tax hike kind of at the same time. And in the view particularly of progressives in that state, they were trying to create some tax equity that had been stymied for years in the past. So on the tax relief side, they put out $3 billion in relief in terms of one-time refunds to taxpayers, tax credits, particularly to low-income taxpayers, and also waivers on most Social Security income. So that's where you have $3 billion in relief. But then they also raised more than $1 billion in new taxes, primarily through a new levy on individuals with investment income over $1 million, and also a new tax on earnings of the earnings of foreign subsidiaries of multinational corporations based in Minnesota. Minnesota is also noteworthy for something that they didn't do. There was an effort which actually passed both the House and the Senate in that state that would have enacted mandatory worldwide combined reporting for the calculation of corporate income taxes. That would have been a significant development because Minnesota would have been the only state in the country to enact this sort of requirement, and it would have abandoned what's known as the water's edge rule, which typically permits businesses to exclude the income of foreign affiliates, and sort of crack down on so-called tax haven income. But as I said, this did not get enacted, but I think it's worthy of mentioning just because it puts that idea out there, and it raises, and it's something that progressive think tanks have encouraged states to enact for many years. And there were states that actually had worldwide combined reporting in the 1970s and 1980s. It was litigated all the way up to the US Supreme Court, and in two different decisions, the High Court said that this was a viable avenue for states to get at some of this offshore income of multinational corporations. Like I said, it did not get enacted, but I think what Minnesota did was sort of open up this idea. And if we have a situation where states go into recession, or there's a real possibility that states are starving for revenue, we will see further discussion of worldwide combined reporting as a way to raise new revenue. So that's it, at least from my side, I think. Oh, maybe Scott wants to talk about South Dakota and Arizona. I don't know.
Oh, well, so I do want to talk about South Dakota, but we could spend an entire hour talking about what Minnesota did. One thing that we haven't included in here, and something that everybody needs to know, is that Minnesota is now becoming the second state to create a retail delivery fee. So starting July 1 of 2024, so next year, they're going to put in place an obligation on retailers who are making sales into Minnesota to add a 50-cent surcharge, basically a fee, to every invoice where that someone has delivered something that's subject to state sales tax. If it costs more than $100, if you make more than $1 million in sales into the state, and if it's not one of the things that they've exempted, and if you sell clothing, which is already exempt from sales tax. everybody needs to pay a lot of attention to this as it goes through the next few months as they roll out their advice on this, because most of, they copied what Colorado did, which is very complicated, even though it seems very simple. And then they added this clothing concept. So clothing is exempt from sales tax in Minnesota, but it's not going, sales of clothing are not going to be exempt from this retail delivery fee. It's going to be very complicated for retailers who are selling clothes into Minnesota. There were some other attempts to do some things. South Dakota was going to exempt groceries. They decided not to do that. Instead, they lowered the sales tax rate, which is a very unusual thing these days. There's a lawsuit going on in Louisiana challenging the constitutionality of their sales tax system, the complexity of that system. I expect Alabama to lower their sales tax rate on on groceries this year. It's sitting on the governor's desk. We'll see what she says. I don't know why she would veto it, but there'll be some more changes come along as this year goes on. So
Louisiana just dropped that $200 threshold,
yes,
200 transaction threshold.
Yeah, they did indeed. So Alex, let's talk about sales tax risk assessment.
Yeah, absolutely. Thank you so much, Scott. And I mean, for everyone on the call today, Brad mentioned, what we were bringing to this conversation is just to sort of be able to speak to what we're seeing day to day with our customer base in the Sage world. I think that this is obviously it's not changing in terms of being a very complicated topic. Most of the people that we talk to are still very unsure of where they stand from a nexus standpoint. Obviously, this stuff is changing still month by month. So I would say 9 times out of 10, when a customer comes to us wanting to engage and start a project, where we're starting this is with a risk assessment. So we have a few different options here at Avalara. A couple of our basic options are highlighted here on the screen, but something we have been offering throughout the year is a free sales tax risk assessment through our Sage partnership. And this is a place that I really recommend, if you've got any questions at all about whether or not you're doing this the right way, this is a great place to start because it's free and it just gives you some insight into where you stand. But essentially what this assessment is a questionnaire that we can give you access to that allows you to go through and answer questions about what business activities are happening with your business in each state individually. So it will cover anything that could potentially trigger physical nexus, but also we'll ask some questions about economic nexus. And this is a really basic assessment just to kind of give you an idea of, where do you stand over the last 12 months. We also have our full paid assessment, which is $4,500, which is going to give you a little bit more in terms of access to our tax advisory team to get some assistance with making decisions on what to do once you've actually uncovered maybe some nexus that you were unaware of. So we would go through the process of telling you about voluntary disclosures, which are an amnesty program offered by the states to allow you to enter those states penalty and interest free. So there's a lot of options here. This is where we start, like I said, 9 times out of 10, because most of the businesses we're interacting with day to day are still just not sure of if they're actually registered in the right places. So both the free assessment and our full paid assessment are great places to start to get some answers to that question. And if we want to move to the next slide, once the risk assessment is complete, generally the way we're working with clients is helping them to figure out what pieces of our software are actually going to fit their day-to-day and help, once you decide maybe you've gone from one state that you're registered in to 25 states you're registered in, that's a big change in terms of what you're having to deal with day-to-day. And we go ahead and complete the slide out. I'm just going to talk a little bit about our full solution. So we have 4 sort of primary products. We have a lot more to offer than that as well, but these are sort of the 4 main products. Most of our Sage clients are purchasing day to day to help make this process streamlined. So, I always explain that what Avalara is in a nutshell is a cloud-based tax engine. So the way we work is we have direct integrations into most of the commonly used business platforms. So we have integrations with all the Sage systems. Most of the e-commerce systems that our clients are using, we almost always have a pre-built integration for that. So once those integrations have been established, what we're able to do is override the tax functionality in your systems so that when you are running invoices or people are checking out on your website day to day, a tax calculation can happen automatically based on where that customer is located. So it eliminates the need for you to have to do any sort of lookup or research around rates and keeping tax schedules up to date, et cetera. So that's sort of our most basic functionality, is the tax determination. We also have our exemption management solution, which I have a couple other slides I'll highlight in the next couple about this piece, but this is obviously a very big piece for our Sage clients. A lot of our Sage customers are manufacturers and distributors, and so a lot of what you're selling is not actually taxable, and you've got a lot of customers who are tax exempt. So we have a tool that helps you to manage your exemption documents so that when you are processing orders day to day, we're able to recognize, hey, this customer is not taxable. We need to mark them as such. So we're able to recognize non-taxable transactions. We are also able to, at the end of the month, quarter, whenever it's time to file your returns for each state, automatically file and remit your returns on your behalf. So day-to-day tax compliance, we can handle all of it so that you're not having to intervene at all, really. There's a couple of places where you would be involved, but for the most part, this is happening in an automated format based on however many states you're registered in. And then tax research is the first one on this page, and I'm talking about it last, but tax research is sort of I would say complements our other three systems, in that if you are selling something that's a bit more complex, a lot of our construction customers use tax research. It's essentially a Google database for taxability information. And so it's going to give you access to look up the more complicated items that you might be selling to help figure out, how these items are viewed in the different states. It helps you understand, taxability, jurisdiction information. You get access to actual tax experts. So questions that you have access to get answers to that. This isn't a fit for every client that we work with, but I would say, a lot of our more complicated customers who are selling things that are not as straightforward find a lot of benefit in that tool and being able to have access to get answers to the questions they have day to day. So we can go to the next slide. So ECM, I like to highlight this because if you are a Sage client and you have been a Sage client for a while, I'm sure Avalara is not a new name to you, and you may have seen our certificate management solution in the past, and it was called Cert Capture. We rebranded this platform last year, as well as made quite a few updates to it to make it a lot better. And so now it is called ECM. So if you see ECM, on any marketing advertisements, whatever, that is previously known as Cert Capture. We highlight this because in the Sage world, I feel like most of the time this is the most critical part of our solution. Even now, 5 years post Wayfair, I'm talking to clients day to day that think they don't have a tax obligation because everything they're selling is tax exempt, and that's just not true. And as Scott and Brad explained with Nexus, most of the states do look at gross sales. So you can trigger Nexus based on even your tax exempt sales in these states. And so if you do have Nexus, you have an obligation to collect exemption documents from your customers who are tax exempt. So if you're not charging tax, you should have an exemption document on file for these customers. And so our ECM tool is going to give you the ability to automate this process. And so let's move to the next slide and talk about some of the features in this tool. So there's a lot of features within the tool. It's a very robust solution, but there's two really big functions I like to point out for my Sage clients. So the first piece is that it's going to give you an automated way to collect and manage your exemption documents from your clients. So instead of having to, do it the old school way of having them either email it to you or maybe scan it, or some people may even be physically mailing these documents into you, you're going to be able to send a digital request to your client via email. When you get that email, they will be prompted to fill out the exemption document required for the state that they're in. So it makes it easy for your customer in that it's very clear what you're asking for. But for you guys, it's also great because it's making sure you're getting the correct document for the state that client is in. So day to day, it makes collecting these documents so much easier, and it's also going to alert you when these documents are expiring or if they become invalid for some reason. So, you don't have a dusty filing cabinet filled with old documents that are no longer valid. So it's a great tool for collecting and managing these documents day to day. The other big function is just how it actually works with Sage day to day. So when you are running invoices while we are generating typically that tax calculation, we're also able to check in real time to see if that customer has a tax exemption document on file. If they do, that tells us not to charge them tax. And we're also able to include that information on your returns. So it just automates that full process and makes sure all of your exempt information is also being included on your returns. If you, depending on the version of Sage you're using, we do have actual ECM integrations with some of the newer Sage 100 versions, as well as Sage X3. So you can actually request these documents from directly within Sage. So, you know, all in all, I feel like this is really just a great form of audit support, because when an auditor comes into your office and most of your business is tax exempt, this is where they're going to be able to find errors. And so when you're using a tool like ECM, you're going to have a very easy way to show that auditor that you have, first of all, a repeatable process, be able to pull everything that they need to see by state. We can move on to the next slide. And I think we have a poll question now.
All right, I'm going to launch it right now. If you do feel that you need help, what areas are most concerning? Nexus, no idea if we are registered in the right places. Rates, how am I supposed to keep up with all of that? Exemption certificate management, am I handling this right? Returns filing, this takes forever, or other? So if everyone could take a few seconds to get their answers in, that would be great. All right. Awesome. Thank you to everyone that answered, and I'm going to go ahead and close it out.
And I believe that concludes our presentation. So we can open it up to any questions for any one of our panel speakers.
Rosalinda, this is Michael. I'm wondering if I could have a panelist prerogative to ask the first question. And yeah, I want to ask Scott, I mean, and in terms of the place I live in, you guys know about this too, one of the biggest questions in sales tax at the moment is taxation of digital goods and services. And we heard recently that the Streamline Sales Tax Governing Board, the Federation of Tax Administrators, and the Multi-State Tax Commission were kind of working on some sort of joint statement on, I guess, their approaches to the taxation of digital goods and services. So I'm wondering what Scott thinks about this. What's the significance of those three different organizations issuing a statement of some sort on this?
So we live in a world where there are three associations for state tax administrators, and they all do different things, and they overlap, and sometimes they conflict. And it is unusual, at least in the last 10 years, for the three of them to actually work together on a project, and for a variety of different reasons. So I think it's really important that the three of them are coming out and making a joint statement. I wish I had some idea what they were going to say. But to Mike's point, there is a pretty serious debate going on inside states and in between states and the business community over the methodology used to tax digital goods, and whether it's a subscription to a streaming service, or a subscription to a musical service, or whatever it is. And every state has a really good feel that they have no idea what's going to be next. So the one constant inside state government when it comes to digital goods is they don't know what's coming around the corner. They don't know if their law gives them the authority to deal with what's coming around the corner. They don't know how to have this conversation with their governor and with state legislators. And of course, that makes them nervous. If you're a tax administrator, the last thing you want is someone to ask you a question. You don't want to. You want the law to speak for itself. And maybe that's a better way of saying it. The law should, and they have a good point. The law should speak for itself. You shouldn't have to have an attorney or an accountant or a state tax administrator explain the law to you, because the law should be just abundantly clear when you read it. Almost never is it abundantly clear. And I have been for the last 18 months involved in a project with both the Streamline Sales Tax and with the Multi-State Tax Commission about what is being done out there in the way of taxing digital goods, digital services. How are the states doing it? How do they differ from each other? Because it's how they differ from each other that often creates cost for retailers. You know, it's one thing to know that what you sell is something.
Oh, did we lose Scott?
I think we may have.
I think we lost him.
Okay, well, I can go ahead and ask a question that came from the audience if someone wants to jump in. So the question that was asked was, once you reach the economic threshold, when do you have to start collecting tax, sales tax?
I can answer that. So typically it's going to be the transaction following whatever triggered the economic nexus. However, a lot of the states do have some grace periods that are allowed, you know, obviously giving you time to actually get registered, but it is typically, I guess, by definition, going to be the transaction following the one that triggered an economic nexus.
Right. Thanks, Alex. And then the next question that we had was, what do you see as the major differences between Avalara and TaxJar?
I think for this call, what's really important is that we are the only solution that has integration with Sage. So TaxJar is not going to be a good fit for Sage clients, as they do not have an integration for Sage, which is obviously a pretty critical piece in order to automate. I would say that TaxJar, you know, is something that we typically see for very small e-commerce businesses, more so than, you know, manufacturing and distribution clients, which are what, like I said, most of our Sage clients are. I've been on the Sage team here at Avalara for about 6 years now, and I have never had a client looking at TaxJar at the same time they're talking to us. So it just is not something that is usually applicable for this client base.
Right. Great. Thank you, Alex. And that looks like all of the questions that we have from the audience at this point, Rosalinda.
Great. Well, I think we have one more poll question, and then I'll bring up a thank you slide. I do have one last announcement for the customers. So do you want to launch that poll,
Yeah,
Allie?
sounds good. Gonna go ahead and launch it now. So would you like to schedule a consultation call with Alex or Brad? Yes, maybe, but I need more information first, or not at this time. I have all of the information that I need. So if everyone could take a few seconds to answer this final poll question, the Avalara team would greatly appreciate it. Okay. Thank you to everyone that answered, and I'm going to go ahead and close it out, and I can pass it back over to you, Rosalinda, for your final slide.
Great. Well, we thank everyone for attending the webcast. We hope you found it informative, and you can see just how often tax changes and legislation changes, and how Avalara has the solution to help offset that and ensure your compliance and your automated to drive the efficiency of your business. There is a webcast next week with Sage. It's an Avalara exclusive, invite only. You want to reach out to your partner to see if they attended Sage Partner Summit, and they have the invitation that they can send to you. There will be a very nice enter to win element to that webcast. So again, I'd encourage you to reach out to your business partner and ask them to register you for that webinar next week, June 13th. and it will have all new content. We'll have some deep dives into predictive analytics and how Avalara's solution can help your business with that. So you have here our contact information. Any other questions, schedule that one-on-one consultation. Alex Lyons' information is up there along with Brad Hamlin, and then some other team members on the Avalara Sage team. That concludes it. Thank you everyone for joining.
Awesome. To the Avalara team and Michael from Bloomberg Tax, thank you so much for walking us through your presentation today, and to everyone else, thanks for joining and have a great rest of your day.